Hello everyone, today our group is presenting on a duration and convexity in volatile market using bond X from Sri Lanka and bond Y from Malaysia. First, I'll be explaining about the two important concepts, modified duration and convexity. Modified duration, it is a first measure of interest rate risk. It tells us how sensitive a bond price is when the yield price changes. But duration assumes a straight line, so it becomes less accurate when yield moves around. Second concept, a convexity. It is a second measure. It corrects a modified duration by showing a curve in a price-yield relationship. It explains why price change more when yield falls and less when yield rises. To estimate a price change, we combine both the duration and convexity using a formula that is shown here. In our case, both bonds have the same duration of 5 years and same convexity of 35. But the market conditions are very different. Now I will be followed by my friend.
Now I will take you through the comparative market environment and risk profile of Sri Lanka and Malaysia. First, the modified duration. Both the countries have modified duration of 5 years and a convexity of 35. Next, the market volatility. Sri Lanka has high volatility of 5% driven by macroeconomic instability, political uncertainty, and debt restructuring risk. For Malaysia, it has a low volatility 0.1% driven by stable monetary policy and predictable economic fundamentals. Next, the primary risk. For Sri Lanka, independent credit risk, high probability of default or restructuring, interest rate volatility, large unpredictable yield movement. For Malaysia, the interest rate risk is predictable and moderate. Liquidity risk is moderate, especially during global stress. The next is convexity impact, active and material. Large change in yield value activate the convexity term, leading to asymmetric return. For Malaysia, negligible small change in yield value render convexity irrelevant. Returns are nearly symmetric. Now I will follow by my friend.
Now I'll explain how this volatility differences affects the returns. Using the duration convexity formula for bond X, which is Sri Lanka, since change in Y is large, the convexity term becomes very strong. This creates asymmetric returns. When the yield rises, the loss is negative 20.63%, and when the yield falls, the gain is 29.38%. This extra gain is called convexity alpha, which comes from the squared yield change. For bond Y, which is for Malaysia, change in Y is very small, so convexity is almost zero. These results are asymmetrical, whereby for gain it is positive 0.501% and for loss it is negative 0.498%. So the prices behave almost exactly as duration predicts. This shows that volatility decides whether convexity matters or not. Now I'll be followed by my friend.
Finally, we explain what this means for fund managers. As for bond X, which is Sri Lanka, is suitable for investors who want to take advantage of volatility. They try to earn the convexity alpha during big yield moments. But this bond comes with high risk because of economic and political instability. As for bond Y, which is Malaysia, is better for investors who want safety and predictable returns. The low volatility makes the bond stable and the price change follows duration accurately. To conclude, even though both bonds have the same duration and convexity, they produce completely different returns because Sri Lanka has high volatility while Malaysia has low volatility. This makes convexity very important for bond X but almost irrelevant for bond Y. Thank you.